Capital Readiness Assessment, your complete guide to funding success. Most capital raises don't fail in the lender's office. They fail long before a lender ever sees the deal. Not because the idea is bad, not because the business isn't growing, but because the company isn't capital ready. Raising capital is a lot like stepping onto the ice in a playoff game. The opportunity is there, the skill might be there, but without a clear game plan, even strong teams stumble. A capital readiness assessment is that game plan. It determines whether a business is truly prepared to ask for funding and, just as importantly, to manage that capital responsibly once it lands. For Canadian companies seeking anywhere from $1 million to $500 million, the bar is high. Lenders and investors are not just underwriting profit or projections. They are underwriting leadership judgment, operational discipline, data quality, and risk awareness. Many owners still believe a strong idea and solid sales will carry the day. In practice, this is where many deals slow down or quietly die. A capital readiness assessment flips that outcome. When a business arrives with defensible numbers, clear strategy, clean data, and visible management discipline, funders move faster. They ask fewer repetitive questions. Due diligence feels smoother. Covenant discussions become grounded in facts rather than assumptions, and valuation conversations are easier to support. At its core, a capital readiness assessment is a structured review of how prepared a business is to seek, secure, and manage outside funding. It goes far beyond a pitch deck or a business plan. Strategy, governance, financial methodology, operational capacity, and controls all come under the spotlight. The question being answered is simple. Can this business attract capital on fair terms and deploy it in a controlled, sustainable way? Being profitable is not enough. Having revenue is not enough. Many profitable businesses fail to close financing because their assumptions cannot be defended. Their numbers are not integrated into how the business actually runs, or leadership cannot clearly explain how new capital fits into a 3 to 5 year view. Capital readiness connects those dots. Sophisticated lenders and investors evaluate readiness through 4 interconnected pillars: methodology, integration, operations, and controls. These pillars form the lens through which risk is assessed. Even if different funders use different language, strength in one area cannot fully compensate for weakness in another. Methodology is about how the numbers are built. Funders want to see that assumptions are grounded in evidence, not optimism. Revenue growth should link to market data and execution plans. Margins should tie back to real costs. Cash flow timing should reflect how customers actually pay and how suppliers are settled. Strong methodology also includes sensitivity and downside analysis. It shows that management has tested what happens when growth slows, costs rise, or rates change. As the saying goes, all models are wrong, but some are useful. Capital readiness ensures your model falls into the useful category. Integration asks whether the capital plan is embedded in the way the business operates. If financial models exist only for lenders, funders will notice. Confidence rises when leadership uses the same numbers to set budgets, approve hiring, prioritize projects, and manage risk. Capital should serve strategy, not sit beside it. A well-integrated approach clearly links funding to defined goals such as expansion, acquisitions, or capacity growth, all within a documented 3 to 5 year strategy. Operations focus on execution capability. A strong plan means little if the business cannot deliver it. Lenders and investors look closely at systems, processes, and reporting discipline. They want to know whether the organization can scale without breaking, whether reporting is timely and accurate, and whether management actively monitors performance against plan. Businesses that can back-test forecasts against actual results and explain variances signal maturity and control. Controls form the trust layer around everything else. They include governance, approval authorities, independent review, and documented policies. Someone builds the model, someone challenges it, and someone approves it. That separation matters. Controls do not need to be heavy or bureaucratic, but they must be visible and real. Independent review, whether internal or external, adds further confidence that bias and simple errors are being managed. When these 4 pillars are in place, capital raising changes. Funding timelines often shrink by 40 to 60% because most lender questions are already answered. Back and forth is reduced. Negotiations become factual rather than emotional. Relationships with lenders and investors start on a stronger footing and tend to remain healthier after closing. This is where firms like Equis Capital Finance add value. When a business has done the internal work, clarified its strategy, and built defensible numbers, Equis can step in with structuring expertise and deep lender relationships. Preparation combined with execution turns readiness into funded deals. Capital readiness is not a buzzword. It is the difference between guessing and managing, between pitching and being underwritten. If you are planning to raise capital, preparation matters more than introductions. Before you speak to banks, private lenders, or investors, make sure your business is truly capital ready. A structured capital readiness assessment through Project Navigator TM helps identify gaps, strengthen your position, and reduce execution risk. Learn more at www.equisfinance.com.